Hello everyone, thank you for joining me today on week 4's lesson, and we're going to be covering structuring your deal to maximize profits as well as zero money down. We've got a lot of content to cover and a ton of value to share with you guys, so let's jump straight into it. So guys, on this week's learning outcomes, after you complete week 4's lesson, this is what you'll be able to do. And that's structuring your deal using your own money if you have funds. You'll be able to structure your deal using other people's money if you have little to no funds available. You'll be able to structure your deal using the zero money down method if you have no available funds. You'll also be able to use my template to quickly establish what's the best structure to use for your deals, and also implement my property trading secrets to minimize costs and maximize your return. And the whole idea with the Property Academy is how can we automate the processes or put as little effort on the front end and maximize our returns on the other end. And that's exactly what we'll be covering today. So the first unit that we're going to be talking about in week 4's module is structuring your deal using your own money. So guys, before we jump into everything in detail, let's just quickly cover the only 3 strategies you need. And again, that's using your own money, which is settling the deal yourself in your own entity, other people's money, which is settling the deal in someone else's entity, and zero money down, or also known as on selling, using little to no money, settling in the end purchaser's entity. So let's just review what each of these actually mean. So using your own money, meaning you're settling the deal without the help of another business partner, also known as a joint venture money partner. That means although you're actually settling it yourself, it doesn't mean that you have to provide all the funds yourself. We actually cover all the different sources of funding that allow you to settle the deal yourself and actually settle it in your own entity, also known as a company or a trust or any type of entity you set up. Now, other people's money, basically this option normally comes into play if you can't obtain money to settle the deal yourself, and often a percentage of the profits will be shared with a JV money partner. This is also a good option should you feel the risk also outweighs the profit. Using a JV money partner can often offset the risk, and you can also structure the agreement so you don't have to worry about the loss should you come into a loss. And lastly, the zero money down method, also known as on selling, is ideally in a perfect world you actually have another buyer lined up for all your deals that's actually willing to take on the deal at a higher price than you paid, and also settling on the same date of your original agreement. We'll actually cover how to increase your chances of doing a zero money down deal, as not only is it the easiest option to execute, it's also generally the most profitable due to not having other costs to worry about. Which normally we're talking finance costs and holding costs and interest payments and so forth. We'll also cover the different methods on how you can actually on-sell. So guys, before we go out into the real world of property trading, it's actually very important to have the correct company structures set up from the very beginning. Not having the correct company structures set up can actually cost you thousands and thousands of dollars by actually changing the names of your properties and switching them into different entities. Now, I actually originally had this problem when I first started out, and it did cost me a lot of money to actually correct the company structure, and that's something definitely you don't want to be doing if you can avoid it. So what we're going to be covering, what you guys should be doing in setting up the company structure from the very beginning is talking to your lawyer and accountant and understanding all of this so that you can do it correctly from the very get-go. And the things to note down and to cover is basically incorporating the correct company structure, understanding the different implications between a property trading entity versus a property holding entity. Now, basically a property trading entity is where you have intentions of selling the property, versus a property holding entity is an entity where you don't actually intend to sell the property. So it's important to understand the differences of both, and again, your lawyer and accountant will be much better at actually explaining this to you. You'll also have to be registered for GST as a property trading business, and again, if you need to look into this further, your accountant or lawyer can help you out in regards to this. Now, I'll also cover how to incorporate a shell company for protection and why it's actually needed in the world of property trading. Now, not that we expect anything to happen, but it's always good as a precursor just to have extra protection in place while we're running a business. And lastly, we'll actually cover the nomination process on how to actually utilize the shell company that we've created that helps us protect our company, and how we utilize this process on every single deal that we do. So guys, you can see on this screen here that I've actually got two diagrams where you can see the differences between personal assets and company assets, and why it's actually important to set up your company structure in two different entities that separates your personal assets versus your company assets. And basically, again guys, because I'm not a financial advisor, I do suggest you speak to a lawyer or accountant for clarification of this process. So this is just basically my opinion on how it should be done, but it may or may not be correct for you guys. So I do encourage you to speak to a professional in relation to this. Now, there are benefits in setting up a company because that actually means that you'll have limited liabilities in regards to your trading business. Now, for example, if someone actually wanted to sue you in relation to your trading business, the maximum you can lose out on is actually the total assets owned by that company. Therefore, anything that you hold personally is actually unaffected, and the other party actually wouldn't be able to go after your personal assets. So you can see the two different entities that I've put aside. On the left, you've got the personal assets under Joe Bloggs, and the personal assets are Joe Bloggs' private home, his personal car, his home and contents, which is just furniture and refurbishments and stuff like that, and any cash deposits that he has in any other form of investments. Now, his company assets that are under the property trading business are all properties associated with that business that are bought for the intention of selling. So anything to do with that is not going to be tainted on his personal assets, meaning that should someone actually go after Joe Bloggs for a deal that's gone wrong, well, they can only go after the company that's doing the property trading and not his personal assets. Now, I personally haven't come into any situation where anyone's tried to sue me or anything like that, and it's very rare in the world of property trading, but it's always good to have that extra protection just in case. So next guys, what we're going to be covering is a shell company and how you can actually utilize a shell company for further protection in relation to your trading company. And again, a lot of the slides on this week's lesson would need clarification from a accountant or your lawyer, because again, I'm not a financial advisor and I can't be kind of giving you the facts because I'm not a financial advisor. Although this is my experience using these methods and it's worked for me. However, again, speak to a financial advisor, accountant or a lawyer for clarification on this process. Now, basically a shell company provides additional layer of protection for your trading company. A shell company is just like any other limited liability company, except that it actually holds no assets, and its sole purpose is actually to purchase property in its name to nominate into your trading company before settlement. This reduces your exposure should someone try to sue you during this purchasing process. So again, it basically de-risks the deal and ensures that people can only go after the actual shell company. So you can see that basically on every purchase, we will be purchasing under the shell company, and then right before settlement, we'll be nominating the purchase of the sales and purchase contract over to the actual trading company that's going to take on the deal. Now, during the process before settlement, if there's any complications or if anyone wants to sue anyone, well, guess what? The only company that's actually going to be affected is the shell company. You know, the other party doesn't actually know which entity you're going to be using to actually settle out the property, so they can't go after that entity. Meaning that the shell company doesn't have any assets, which means that whoever's trying to sue you won't have anything to gain. And you can see that the shell company is over on the left hand side, and basically it's only used when you're purchasing a property, and once purchased under the shell company, we transfer the property over to the trading company. On this screen here guys, you actually see an example of what a nomination form actually looks like. And on this week's materials, you can actually download the nomination form and go out and use it when you're nominating from your nomination company to your actual settlement company where you're going to be doing your property trading from. And you know, I've actually paid a lot of money from my lawyer to get this drafted up for me, so you know, you guys don't have to go out and redo it. You can just use what's working, and you know, this is an actual real binding document that is legal, and you can actually really go out and use it. And basically the nomination process has kind of four major parts that I've highlighted for you. So the first section is the date of the nomination, and often it should be before the actual settlement date. Now, number 2 is the name of your companies. This is where you write your trading company's name as well as your shell company's name. And one person is going to be the assignee and one person is going to be the assignor. And just to make things easier for you guys as well, on this week's materials, I'll actually give you an example of what a completed nomination form looks like so you guys can really understand it and actually go out and apply it yourself. Now, the third section is where you write the address of the property. It's the full address that you're dealing with. And number 4 is the signing of both directors of both entities. Now, often it's the case that because I'm the director of both companies, all I'm doing is signing on behalf of myself and signing again as the assignee. So I'll be signing in both sections because I'm the director of both companies. So you can see an example on this week's downloadables to get a better idea of how you can actually go out and apply this. But I do this every single purchase to ensure that all the deals are de-risked and the only entity at stake would be my nomination company, which actually has no assets or no money tied into it. So again, it's just another layer of protection, and it's something that my lawyers and accountants actually suggested for me to do. And it's worked wonders, and we haven't had any issues anyway, but had we had any issues, it just means there's an extra layer of protection. So I highly recommend you guys use the exact same process, and that means you're going to be able to de-risk the deals moving forward. So on this slide here, guys, we'll be talking about GST, and I'm just going to cover it briefly because, again, for better clarification, please speak to a financial advisor, i.e. your accountant or a lawyer that can better help you understand this. And GST can be a little bit confusing in the very beginning, and I know it was the case for me, and it really took the explanation of the financial advisor being my accountant or my lawyer over the few deals before I really started to understand it. So you definitely want to understand this correctly before you go out and start trading, because it can really stuff up your numbers if you don't know what you're doing. So basically, who has to actually register for GST? Now, any business in New Zealand actually has to be GST registered, because if you make more than $60,000 a year, or your turnover, your revenue is actually more than $60,000 a year, you have to be GST registered. Now, you can already imagine that with property trading, it doesn't take very long for us to be over that 60,000 threshold. Now, it's even with just 1 or 2 property deals, we'll already be shooting above the 60,000 mark, which is why we have to be GST registered. Now, there are benefits of being GST registered, which is, firstly, you can pay less for most business expenses, and it's good for business cash flow. So I'll just explain this in a second to you guys as well. So what that means is you can claim the GST portion of all your expenses, and in most cases the cost of your property you purchase, this effectively means that you're paying less for all your expenses, but remember, you also have to pay GST on any income you make, i.e. when you actually sell the property. Now, it's also good for business cash flow, because when you actually file GST returns monthly, which is the setup that I've got currently for my business, as property traders, we want as much cash flow as possible. So when we actually utilize the GST portion and we claim this back at the end of the GST period when we're doing the return, we can actually cycle the GST refund and use it as purchase money for other properties and use it as deposit money when we're going out and doing other deals. Now, again, keep in mind that you do have to keep in mind that you are going to be paying this money back when you actually sell the property when you're filing your GST return. So you have to have good kind of financial management to realize that when you're actually expected to sell the deal, you better have enough money in the bank account ready to pay that GST bill back off. You don't want to be pulling GST from a deal and using all the money and going on a shopping spree and doing all these deals only to realize that when you have a GST bill payment coming up, you can't afford it, because in that situation, you're going to have to pay interest and a whole bunch of penalties and other things that are going to cause more hassle that it's not really worth it. So talk again to your accountant and your lawyer to have a really good understanding of this, and even go do your own kind of self-education on understanding how to actually take advantage of using GST and applying GST to your business. And just on that note as well, guys, I just want to mention that it's not every expense that has GST attached to it. Certain things like interest payments, which is a normal expense that we pay when we're buying property and getting a loan out for the property, we can't actually claim the interest portion for it, unfortunately. Again, ask your accountant or your lawyer for further clarification on what you can actually expense and what you can't in terms of being a property trading business. So I'm actually going to go over an example of how you can actually claim the GST when you're purchasing a property, and kind of go over on how this all really works when you're going out and doing property trading. So you want to be setting up your monthly returns, your GST returns, so that they do come in every month. And there's different time frames you can set these up. I believe there's 1 month, 2 months, 6 months, and yearly. So you definitely want to do it month on month, because that's going to provide you the most benefits. So on the screen here, you can see I've got the example of when you purchase a property and when you claim the actual GST. So that's on the left-hand side where we talk about purchasing, and on the right-hand side, we talk about what GST we have to pay when it comes time to selling. So let's just look at an example, guys. So we go out and we buy a property that's $500,000. That's what we're prepared to pay for the property. And the vendor is actually a home buyer, or he's a homeowner occupier that's selling their property. And basically, because he's not a business, he's not GST registered, we're actually able to claim the GST portion back. Now, 15% of 500,000, when we claim that back, is actually $65,217. So our actual real purchase price for the property at the time is only $434,783. Now, the good thing about how we claim the GST is, say for example, we actually purchased the property sometime in the beginning of June. While our GST return, when we file it at the end of June, we're actually going to quickly receive our money sometime in mid-July, sometimes even earlier, in very early July. Because once you file your return, and if it's done correctly, you're going to be able to get that GST refund back into your nominated bank account. So you can imagine how beneficial receiving an extra $65,000 is, because that means I've just created a bigger pool of funds where I can go out and use that $65,000 as deposits for other properties. Now, when it comes time to selling your property, unfortunately, that GST payment that you claimed is only temporary, and when you actually sell the property and file your GST return, you're going to have to be paying that portion back, plus maybe extra when you've actually made that profit on top as well. So let's just look at an example of how much we have to pay and how it all works when it comes time to selling. So let's just say, for example, we end up selling the property in July sometime, let's just say at the end of July, for $550,000. Now, when we sell it, we have to pay 15%, which is the GST portion, and that ends up being $71,739. So you can see that the GST to pay is actually more than the amount we've actually claimed back. And that's because we've actually sold it at a higher price. Now, our actual real sales price, if we take the GST portion off, ends up being $478,261. Now, our actual real profit pre-tax becomes $43,478. So you can see how all of this works. And basically, if you've sold the property, say, for example, in July, sometime mid-July, and it's actually settled sometime in July as well, when you're filing the GST return at the end of July, what you have to be prepared for is, come August, you're going to have to be paying back that $71,000, and you should have the money ready to go in your bank account. Now, the problem lies with very kind of novice property traders that don't understand the GST process, and when it comes time to paying the GST bill, they've actually spent the money, or their money is actually locked up in other property deals. Now, that's going to be a big problem, because you can't avoid paying GST, which is a goods and service tax, to the government. It's a very much needed contribution, and it's a very normal process of doing business. So please keep this in mind, and please understand this very carefully, and talk to an accountant and talk to your lawyers to clarify this process very early on, so that you do prepare yourself when it comes time to paying the GST bill, that you actually have the money ready and available. Now, if you don't actually pay your GST bill, it can be a legal complication, because basically you're avoiding a form of tax. And not only can you be charged with extra penalty interest, it could be actually a criminal offense as well. So you don't want to be doing anything that involves more hassle than it's worth, and it's better to have things prepared and structured correctly from the very beginning. Now, the first method of how to structure your deals that we're going to be covering is using your own money. And the things we must ask ourselves when it comes to deciding whether this option is fit for our situation or not is to figure out the following questions. What deposit amount do I have? What will the major banks lend me? What other sources will provide me funding for the deal? Do I have enough funds to actually cover me during the holding period of how long I'm going to be keeping the property before it sells? do I need to pay for any renovations? These are all the important questions, and you need to answer all these questions before you decide that using your own money is a method that works for you. So the deposit amount that you have access to is actually really important, because often when you're going out to a major bank or a second tier lender or other sources of funding, they'll actually require you to pay a form of percentage off the property value, or at least off the property purchase price. Now, the deposit range can actually range anywhere between 5% to 40%, and of course it works in our favor where we can pay less than more. It's better for our cash flow, and it just means that we can reserve more money for other situations and do more deals. Now, if you get presented the option of paying a percentage of the actual property value or the actual purchase price, it may pay to actually go for the property value, because it means that sometimes if the property value is quite high, the person lending out the money may be happy to cover 80% of the actual value. And if you have actually purchased it a lot below the actual property value, then your deposit amount can be a lot less as well. So that's just something to keep in mind as well for you guys. So the next question to figure out is, what will the major banks actually lend you? And basically there's a few points to cover, which is owner-occupied properties require at least a 20% deposit, while investment properties actually require a 40% deposit on your actual purchase price from the major banks. Now, the mortgage can actually be charged on a interest-only basis or a principal and interest basis, and what that means is you can actually pick whether you only want to pay the interest off the loan, or you actually want to pay off a little bit of principal as well. Next is the bank's rates are often cheapest in the market when you're working with the major banks, and currently that market rate will range anywhere between kind of 4% up to 6% per annum. And basically the rules for the banks is they set their own rules. And I always say that whoever has the gold actually sets the rules, and that's definitely the case with the major bank. So you want to be very careful, because you will be playing according to their rules, because it's their money that's lending out to you. Now, just a few things to note. Major banks generally only lend for home ownership and not for property trading, as this is considered a business. But again, you want to be talking to your broker or accountant and lawyer about what options you have for your first deal. Now, I have actually heard of people utilizing a 20% deposit as a first home deposit when trading the property shortly after to turn a profit. And I've heard of people doing 1 or 2 a year, and you might even get away with it without tax implications. But this is something that I don't advise, and again, I would talk to professionals about this method if you're looking into it. Now, it's also important to note that when banks actually lend money to you, it is what is called a mortgage, and the banks still own the property, especially if they've provided the majority of the lending for you. Now, should you actually miss any interest payments, the banks do have the rights to seize your property and sell it at mortgagee to reclaim their loan. So again, it's something you want to be staying on top of and having a good sense of financial management to ensure that all your mortgage payments are actually met, all your interest payments per month are actually met. And of course, the benefits being cheaper rates is also very good for our holding costs, but the disadvantage working with banks is sometimes that the hassle of getting money and the loopholes and paperwork you have to go through can be quite lengthy to finally get to the end of the funding process. So the next source of funding we'll be actually talking about is second tier lenders. Now, second tier lenders can actually be private companies or a mortgage broker with a network of wealthy individuals that are happy and prepared to lend money for your property trading business. Now, there are a few points that are very different compared to a second tier lender versus a major bank. And that is that they actually understand your business. They understand how it works, and often a lot of the people lending out money have possibly been in property trading themselves. Second tier lenders actually have their own set of rules as opposed to the major banks' rules. Most of the rules are very similar, but the second tier lenders may have other restrictions, or they may have other implications if you miss payments, and there could be penalty interest payments and stuff like that as well that the major banks might not have. Now, the fees involved and interest rates actually normally sit around 8 to 12% or higher. And there's normally a establishment fee in place when you're setting up the loan on top of the interest rates being quite high. Now, this fee is normally around the 1% mark on the total loan amount. We typically, my business typically doesn't pay any more than 1% on the actual loan amount for an establishment fee or a brokerage fee. And I suppose some of the benefits working with a second tier lender is that they can actually sometimes finance up to 90% of the property and sometimes even 100% of the property, because depending on the lender you're working with, they may actually lend on the actual valuation of the property rather than the purchase price. And if your purchase price is a lot lower than the actual market value of the property, well, your lending is going to be a lot more and you don't have to contribute as much money yourself. And, a lot of property traders like myself are unfortunately actually forced to work with second tier lenders because, they're not part of the major bank and they are often privately owned. And the reason why is because they don't require consistent income. Now, although my income is very consistent, the banks may still feel that property trading is a risky business, despite, knowing the methods that I apply can de-risk every deal I do. However, if the banks aren't prepared to lend and the only option is second tier lenders, well, that's the option I'm going to be using because I'm not going to let the bank stop me from running my business. So in essence, I suppose second tier lenders understand your business a little bit more and they're a lot more lenient because they're actually happy to lend to you as long as they know that your property purchase price is well below what the actual worth of the property is. Because worst case scenario, and the bank should realize this as well, is that you could actually take over the property and sell it back on the market and realize the loan amount that you've lent out anyway. Now, second tier lenders, being similar to a bank, they will still be putting a mortgage on your property and they still have the authority to basically seize the property should you miss out on payments. And in cases where a vendor's actually got both a bank mortgage and a second tier mortgage, and in the instance that they've actually missed the mortgage payments, well, the bank can actually put the house on the market and receive its loans. However, the second tier lender or the second mortgage would only get the remaining money left over should there be any money left. So a second tier lender is at risk a little bit more than an actual bank when the bank's actually lending money out. And that's sometimes why the rates are a lot higher as well, to cover that risk and ensure they actually make a little bit of money when they're actually lending on a risky deal. And depending on how risky the deal is, would depend if the second tier lender would require extra security on other assets that you might have. And again, it's just a case-on-case situation. So, there are pros and cons with both using a major bank and pros and cons with using a second tier lender as well. Often I find that second tier lenders move a lot quicker. So if the deal is time sensitive that you're looking at purchasing and you definitely need to pay the vendor the settlement funds, then a second tier lender can generally get things done a lot quicker than a major bank because they're not dealing with as many customers as a major bank would. So less paperwork, quicker for the loan. It does cost a little bit more, but it often, again, if it works in terms of the numbers on your final numbers on what you're going to make on the deal, then it's just all part of the general running expenses of the business. So the next very important question to ask ourselves is, do I have enough funds to cover the holding period? And basically what I like to do, guys, is I always add 3 months in addition to my holding costs just to be conservative. So if I predict that the property might sell in 2 months' time from the date that I've actually purchased and settled the property, I often actually add 3 additional months to ensure that if it doesn't sell during that period, well, the profits and the numbers I've actually worked out actually covers me until that 5-month period. And should I actually sell it a lot sooner than that 5-month mark, well, again, that's just more money in my own back pocket. So it's always better to be conservative because a interest payment on your loans are going to be a big amount, especially if you don't have any rent coming in. Because keep in mind, while you're taking over the property, if you're renovating it, it's all purely expenses and no income actually coming in. And if we actually look at, for example, a $500,000 loan on a property purchase that we've gone out and bought at a second tier interest rate of 10%, that actually works out roughly to be about $4,000 a month of just pure interest payments on top of any renovation costs that you've got going on. So, I've actually firsthand seen property traders that have miscalculated the holding period that they thought they were going to have, and it ended up being a lot longer than they thought. For whatever reason, it may be the case that the renovation took a little longer, or the market is taking a little bit longer to respond, or they're trying to sell it in a bad time. Maybe it's a winter, or maybe it's during summer where everyone's actually gone away on holiday. And guys, this is actually the main difference of what makes a successful property trader versus one that will get hammered by those interest rate and go under and actually never trade again. So always have, you know, your financial management, you know, really down pat, because you don't want to be paying more than you should, or realizing that you know, you've miscalculated payments and you're actually going to get forced at mortgagee, and the banks or the lenders actually force sale your home and you lose all your money you've actually invested into the deal. So that's definitely something you want to avoid, and by doing that is to be conservative. The next very big financial question we need to be asking ourselves is, do I have all the money available for renovations that are going to be coming up? And you don't want to actually just look at renovations itself. You want to actually cover all the general costs that are always needed when it comes to buying and selling a property. And you know, that can actually be the difference of adding a few thousand to $10,000s of dollars in your actual pocket if you know, don't get this correctly, or if you actually get this correctly. And some of those general cost items that I'm talking about is, you know, general cleaning, staging, and just kind of general maintenance as well, some landscaping and stuff like that. And that's often overlooked. And, you know, that cost can actually rise up to $2-3 grand very quickly, or sometimes even, you know, $5 grand, depending on how bad the property is. And if that's something you haven't factored in, if you're going out and doing a deal that's only going to make you 10-15,000, well, you know, if you haven't actually factored in $5 grand, that's 1/3 of your actual profit that you're missing out on that you thought would be actual profit. And, you know, after you review those numbers, it may not actually be worthwhile for you to pursue the deal at all, given how little you're going to make after factoring all these costs. So just a few things to factor in, guys, is the actual renovation, the cleaning, the home staging, any lawn maintenance, council rates during the interim of the period where you own the property, any power or water bills as well. And again, include a buffer for unforeseen circumstances. You know, I'm always promoting being conservative, because, you know, applying that has allowed me to be successful in the property trading industry and, you know, running my own property trading business. And that's always to be conservative and include buffers where you can. So guys, on the screen here, it's another reference back to the renovation budgeting tool that we've actually covered on last week's session. And I do actually use this on every single deal. You know, I am conservative with my numbers, so I always overestimate the renovations, and I always put a buffer in as well, you know, on top of the legal fees and real estate commissions and so forth. So I highly encourage you guys to actually use this on every single deal, and, you know, really work out the numbers so you have a buffer in place, and really work on conservative numbers to ensure that you're not actually going to be losing any money whatsoever. So if the last slide was a little bit hard to see, it was actually the real numbers we put in for a deal that we did in Rada Street. And I'll just kind of go over those numbers and sum up everything for you guys. So, you know, for the Rada Street deal that we did, the purchase price was $389,000 and the borrowed amount was $295,000. The deposit paid was $94,000 off our own money, and the renovation cost involved was $11,074. Our total lawyer fees for both the purchase and sale of the property was a total amount of $2,000, and interest and lending fees, excluding the GST portion, is $10,270. Our sales price was $454,000, and that gives us a pre-tax profit of $34,883. Now, if you're actually working the numbers in your head, you're gonna, you know, find it weird or strange how we were able to borrow so much money. And basically how we're able to do this is because we actually approached a second tier lender who was offering to lend on the basis of a valuation. And they're actually lending on the valuation of $485,000 that we had for the property. And we actually got this property renovated before we actually settled the property because we had early access. And after it was renovated, this is what the valuation came back at, and we still had some time before the actual settlement process. So the lender at the time, the second tier lender we're working with, one of the conditions was that they were happy to lend on the valuation price of $485,000, which is what the renovated property was worth. However, they weren't prepared to take into account the GST portion. So they said, look, we'll work on $485,000, but we're actually going to pull back 15%, and we're going to work off the value of $421,000, $739. And they were actually prepared to lend at 80%. So if these guys actually lent at 80% and gave me $337,000, you can understand the deposit that I put forth, the money I had to put forth on my end didn't have to be a lot. However, in this deal that we are working on, we actually only decided to borrow $295,000 and front an extra $42,000 because we actually had the extra funds ourselves. And not only does that reduce the holding cost for the period as well, that means the establishment fees or any fees that we were paying on the borrowing of the loan was going to be cheaper for us as well. So sometimes if you do have the money available, especially if you've pulled the GST out from another property deal, you may want to lower your costs elsewhere by actually putting more money than you have to on certain deals. So the maths behind the profit of $34,883 basically goes like this. It's $454,000, which is what we ended up selling it for, despite having a valuation at $485,000, and we take $454,000 less our purchase price being $389,000. We also deduct the renovation cost, which you can see is $11,074, as well as the legal fees of $2,000. That leaves us with $51,926, and we take the GST portion off that amount as well. So if we take 15% off $51,926, we get $45,153. And lastly, we take that number and we minus off any interest or lending fees, and there's no GST involvement of those lending fees or establishment fees. And when we reduce that from the $45,153, we get a total pre-tax profit of $34,883. And this deal was actually completed in about 2 months' time. So from the purchase to the actual sales process of the deal happened within about 60 days. So it was a very quick turnaround time. And this is a deal that we purchased on the open market through a real estate agent. And you can see that there's some definitely healthy profits in this deal as well. So guys, what are the actual pros and cons when we go out and use our own money and actually settle a deal? And there's a lot of benefits when you go out and do this yourself, which is you actually get to keep all the profits yourself. You don't have to make other decisions with other parties. You can actually do everything yourself, and as a one-man band, you can make all the decisions and have all the direction on the deal and how you want to sell it or who you want to sell it with, as well as how much renovation you want to put in. And there's no money partners hassling you because it hasn't sold. So the pressure of working with money partners sometimes is that they're always breathing down your neck, thinking, well, when's the money actually coming? I'm concerned because I've lent you this money, and that's a pressure that you don't actually need, or rather don't want to have. Now, the disadvantages when you are working with your money, your own money, is that you bear all the risk. Now, if you're onto a winner, that's all good. But at the end of the day, we can't forecast on how much the property will actually sell for and whether we're actually going to make a profit at all. So most of the time when I go out and settle a property myself, there has to be a very decent profit margin in it for me. Otherwise, I'm not prepared to put it in my own name, and I may prefer the JV money partner option or using other people's money. Reason being is because nothing is guaranteed. There's no forecast. There's, the only thing that we can actually predict is death and taxes. And if that's the case on a small margin deal, it's something I don't want to bear the risk on. Now, you can actually see for the Rada Street example that we've just went over that although the valuation was at $485,000, our actual sales price was only $454,000. So we're about 30 grand short on where it was supposed to be valued at, or what it should actually sell for. Now, having this being the case, you always want to be conservative, because we never know if the actual sales price is going to be in the vicinity of the actual registered valuation. And we could have waited longer to try get a higher price, but equally sometimes we don't try to maximize every single dollar, every single penny, and it's actually more cost effective for us to take the money and run and put it onto another profitable deal. And the other disadvantage when you are working with your property using your own money is that your money is actually tied up and you can't do other deals. So if it's the case that my money is all tied up into my own deal, well, unfortunately for the next deal that I'm working on, I have to use a money partner, or I have to use the on sale option, because those are the only options available. And if it just happens to be the case that the next deal that comes up is actually a lot more profitable than the deal that I'm working on, that I've sunk in my own money in, well, guess what? I'm going to have to be splitting those profits with the money partner. So, the main conclusion for me, guys, when I figure out if I want to settle the property using my own money or not, is if there's a very, very healthy profit margin, I go ahead and put my own money down and bear all the risk. If there's not, I'd rather split that risk by doing the deal with someone else and also splitting the profits as well.